Welcome back to the podcast. This week we're going to be covering guarantor loans, or sometimes referred to as the bank of mum and dad. Guarantor loans have become very popular in recent times for people looking to get onto the property ladder, as it significantly saves the time needed for a deposit. So today we're going to be covering what are guarantor loans, who do they suit, and also discuss some of the benefits and risks attached to them. Joining me today is Dyl. Dyl, welcome.
Thanks for having me.
You ready to get stuck in?
Yeah, let's get into it.
I guess the first question is guarantor loans, like we just discussed, sometimes bank of mum and dad. What are they?
Yep, so more commonly used where a family member, so for example, mum and dad, can be a brother, sister, use up their security, their property as security for the application. So, you know, some misconceptions are that it has to be cash from mum and dad as the bank of mum and dad, but it's a property that we're using as security to help the child, in this case, purchase a home.
So it basically just covers the gap in the deposit, like we just discussed. So so how does that actually help the borrower?
So to keep it simple, it gives, I guess, the client access to the best products, rates and fees in the market. So one of the big ones is, you know, it's quite hard to save 200 grand for a deposit, for example. So if you're going in with a lower deposit, you might be required to pay lender's mortgage insurance, but when the guarantor is available, you would avoid lender's mortgage insurance. So some big savings off the bat, which is really good. It means that, as I said, the customer or the client doesn't need to save that chunky 20% or 10% deposit, so it gets them into the market quicker, which is a big thing at the moment with the way the market's moving in Perth. So given it's been running away for the last couple of years, if it takes them 5 years to save 200 grand, that's where the guarantor option is really a great option for the clients.
Yeah, it definitely is. In terms of how it actually works, like the metrics of it, can you just give us a quick example?
Yeah, so let's keep things nice and clean. If we're looking at $1 million purchase, right, the way we would like to structure our guarantor loans is the client will borrow the 80% on their property. So if it's $1 million purchase, they'll borrow 800,000 on their property. Yeah. We will then look at the parent's property, which is providing the guarantee, and essentially we will secure a 20% loan onto their property and our client's property. So looking at a $200,000 loan secured to the property of mum and dad in this example. The way we do that, and the reason why we like to differentiate the two, is just so we can clearly identify what's guarantor portion and what's, I guess, the main loan portion for the customer.
Okay. So you just mentioned, using that example, so you got an 800K loan and a 200K loan. Whose name is that loan actually in?
Yeah, really good question. And one of the big things that we go through with the guarantor. So the client, in our case, is the borrower. So they're liable for both loans.
Okay.
They're borrowing it. It's all in their name. They're liable for the repayments. It's just that 20% portion is linked to the parent's property.
Okay.
So the customer is making the repayments across both those loans.
Okay. And they're fully responsible for the loans, and basically the guarantor just has that secured against their property.
Yep. They're providing a security for that 20% portion.
Yeah. Awesome. So it sounds like there's some great benefits. So let's just spend a bit of time on those. Can you just expand on a few of them? So I think one of them will be entering the market sooner, right? If we're talking about the Perth market at the moment, as we have in previous podcasts, given how hot it is, that's obviously a huge benefit.
Yeah, so getting into the market quicker, not having to save that chunky deposit, especially for people with good incomes, it just means they can get into the market quicker, secure their home, whether it's an owner-occupier or an investment, means they can get in quicker. We touched on LMI, lender's mortgage insurance, just before. That might be $10,000, $20,000, $25,000, $30,000 that they'll save. So big savings straight off the bat.
Yep.
In our situations, we really like to utilize it as well when the customer might have a portion of savings, but we might want to set that aside. So they'll still borrow the 100% of the property, but they might have 50 to 100 grand set aside as a buffer. We put that in the offset account, buffer for personal, buffer for house, buffer for other investments potentially. So it gives them the best of both worlds, where they have the flexibility to keep that cash. And it might mean, in certain suburbs where prices are increasing, they can get into that, particular suburb earlier rather than having to save and take that extra time.
The one thing I just want to go back to about keeping the savings as a buffer as well. So, we note that, we can potentially borrow 100%, with clients that have this cash as well. They're going to need some cash to cover your costs, your stamp duty and stuff like that as well. So having that cash buffer in those instances is important, but it's probably also worth just quickly noting that, if someone had basically minimal cash and still wanted to buy, I think there are some lending options where you can actually leverage more than 100% to cover the costs as well.
You can. So
Yep.
stamp duty is going to be the largest cost when purchasing a property. And in under these structures, you can actually borrow the stamp duty if the customer wanted to.
Yep.
We will set it up all case by case, right?
Yep.
But yeah, given it could be, 20, 30, 40 grand for stamp duty.
Yep.
If the customer's got it there and we want to use their cash to pay it, we can. But if they've got, on the lighter end of savings, we want to keep aside a buffer, we can actually borrow that as part of the guarantor portion.
Yeah. Like you said, I think that's just a case by case,
Yep.
assessing what the client's cash position is, what's the purchase price. And then, like we said, we always like to leave a bit of a buffer. I think
Yep,
that's very
really
important.
Really important. Because as we know, when buying property, especially if it's an older property, things can go wrong. So having that buffer is really important.
Yeah.
But also for personal and lifestyle planning, setting aside that buffer is really key to the overall strategy.
Yeah. So it sounds like there's obviously like heaps of positives for the borrowers, right? So what's in it for the parents? What's good for them?
Yeah, the big one, as we've touched on a couple of times, is it can take time to save that deposit. So rather than the parents gifting their kids cash, they don't have to do that. So essentially, they're just putting up their security. They're not on the line. They're not having to front up 200, 300 grand in cash. It means they can set it aside for their own personal plans and retirement, whatever that might be. A key one is, it will support their kids getting into the market quicker. Also from a wealth creation point of view. So, getting into the market, getting them set, property is a long-term play. So the earlier they can get in, the more comfortable they are, sets them up, really, really good. And I think we've touched on it throughout the last few podcasts, is that obviously the prices in Perth are increasing somewhere, sometimes 1%, 2% a month in the last few months. It's not going to run away from them. So just getting them into the market earlier when they're ready to go. Yeah,
absolutely. So benefits done, then there are obviously, as with anything, there's always some risks involved. So I guess in terms of the parents or the guarantors, what are some of the risks for them?
Yeah, so we'll always sit down with the guarantor and take them through the benefits and I guess the risks, because they are, at the end of the day, providing their property as security. So what we'll sit down and say is, look, whether it's your owner occupier or one of their investments, it is a mortgage that is going to be secured to that property. So what are your plans? Whether it's retirement, what are your plans with the property? You're going to downsize if it's your owner occupier, if it's an investment you're going to sell. At the end of the day, it is linked to their property. Whilst the clients or the customers are making the repayments, if things were to get a bit messy and for example, the repayments stop getting made, then the guarantor will be brought into it because the property is secured to their property, to the loan secured to their property. So they got to understand, it is a safe option, but at the end of the day, it is secured to their property. The biggest thing we always say is just what the plans are, right? So just sit down discussing that with the guarantors to make sure they're comfortable that there is a limited guarantee or a portion of the loan that is going to be secured to their property.
Just on that, the limited guarantee portion, I think it's important to touch on that. So using the example that you discussed before with $1 million purchase, borrower's loan is 800 and then there's a 200 grand guarantee amount, which the borrower is also responsible for. That is the absolute maximum that the bank can go after a guarantor for. Is that correct?
Yeah. So the 20% portion is what's being secured. So if, they had to sell, for example, the clients or their kids' property, their 80% loan will get cleared out. And if there's a difference between, the remaining 20%, if there's a shortfall, then that's what they'll go after.
That's the maximum amount
if they can't find the customer, of course.
Yeah, so, exactly.
Yeah, it's very clear. We make sure it is a limited guarantee because you don't want them to be liable for the full debt.
No.
That full debt being secured to their property. So we avoid that at all costs.
Absolutely. So in terms of what about for the parents, their borrowing capacity, if they have intentions, like you said, we always discuss with them, what's your plans looking like? If they had intentions to go and borrow further money, does it impact them?
No, it doesn't.
Okay.
So, because the loan's not in their name.
Yeah.
The one thing that we just need to be mindful of is the fact that their equity on their home will have reduced because a portion of that debt, in our example, the 200,000, is secured to their property. So if they're looking to access equity, or they're looking at another child to do the family guarantee or the guarantor loan, which they have to be mindful of, but it doesn't affect their borrowing capacity because the loan's not in their name.
Okay. I think you already touched on the fact that retirement plans as well, if they're planning on selling assets, whatever the case is. And then the one other thing which is going to impact, I would say, both parties is a sort of an emotional or, I guess, family strain that this might potentially bring on as well, that we talk to both parties about. So can you actually just address both of those?
Yeah. So we always like to have these conversations, sometimes separate with the borrower. So we'll sit down with the guarantor just to completely make sure that they're comfortable and understanding of the setup, because, family and money sometimes don't always mix too well. So, 9 times out of 10, we never see any issues. The family members are obviously trusting of their kids. So it's just making sure they understand the structure and the setup. And we, make sure there is no pressure on either end to get that set up. Making sure they're comfortable is obviously really important.
Yeah, just further to that, and I think you briefly mentioned it before, it's like, if parents have got multiple kids and they want to be able to assist multiple kids, is it once I help one, then we can't help the others?
No, not the case. So we'll review the security that they're using, make sure there's enough equity there. If there's some current debt on there, we'll just see where that stands and making sure there's enough available equity for the first one, for example. And then if there are plans for other kids to do the same, we'll paint in a full pitch to let them know if it's possible.
Yeah, and then that's only on the assumption that they've only got one. The guarantors have only got one security. If they've got multiple securities, it's even less of a problem. And if guarantor properties, in terms of the maximum that a bank would leverage against, it's what's the maximum loan to value ratio?
Yeah, 70% is the standard. There is a couple that will go to 80, but the majors are ANZ, CBA, NAB, for example. Not NAB. Westpac, they're the most common ones in the 70%.
70%.
Yeah.
The one other probably key can be considered as a risk is we mentioned that the borrower is borrowing 100% of the property value, right? So they've got to be able to demonstrate that to a bank that they can service that loan. So with that, there's a level of comfort, but still you're borrowing 100%. So
you are leveraging up, right? So that's where we sit down with our customer and say, look, what's your employment situation? What's your, your income levels? What's your income growth? Making sure they're comfortable with the repayments at a starting point, because you are borrowing 100%. And like any market, it's cyclical, right? So if the market does slow down and it does come back and property prices do decrease, we've got to make sure in the long run that they're going to be all right and they start to pay down some debt. So it's mainly around the borrower's position, what their future looks like, and their income to make sure that they can sustain those repayments at that 100% borrow.
It's a good point. That's probably a good segue to go, like, when does it make sense, right? Because whilst it seems an amazing option, it may not actually make sense in some situations. So who does this suit?
So strong applicants, so professionals, tradespeople who have strong income as a starting point. So if there's joint applicants as well, doesn't necessarily have to be, but then there's, a strong household income across both of them. We can see that there's serviceability there and the ability to make the repayment whilst also having a buffer and putting away savings. So that's probably a starting point. The stable employment, so like being in their job for a while, or, are in an industry that's, quite stable in different economic conditions. That's another starting point. The parents being in a strong asset position. So what we're talking about there is that their property's got plenty of equity. They might have multiple properties, whether it's owner occupier or multiple investments, but also from other assets such as investment superannuation. We want to make sure if a guarantor is putting their property up, that their position is strong as well. Because the last thing you want to do is put someone up that's not in the strongest position. They need to sell their property. That's the last thing we want to see, but also the bank. So the bank do have criteria that the guarantor has to meet from an asset point of view. So that's why we sit down with both the borrower and the guarantor to get those details.
Exactly right. The bank really does focus on that side of things in an application to make sure that the guarantors are in a suitable position to act as a guarantor, which is probably also then worth talking about the exit strategy, right, of the guarantee. And that's really what the bank is looking at. They just want to know, at an absolute worst case scenario, if things don't work out, what's the exit strategy? And that plan or the asset pool of the guarantors is basically what helps them.
There's an out.
Yep.
So we're always, as we said, we always discuss the overall strategy with our customers, and in this case, the guarantor, and we'll have a plan.
Yep.
A plan in place to remove that guarantee. So I guess some common options are, at the moment, it would be a case of obviously prices rising, which means there's more equity in the property, paying down some debt, for example. If we can get to a portion over a 4 or 5 year time period where we can refinance out, and we'll look to release that guarantee as soon as we can, essentially. So that's part of our process. We'll sit down and say every year, where are we at? What's our equity position? Can we release the guarantee? Because that's always the goal. We don't want it to sit there forever. We always want to remove it when we can.
Yeah, absolutely. So, and it's usually a combination of factors as well, right? It could be a mix of paying down the loan. It could be increased valuations. The other thing that we're commonly seeing at the moment, which a lot of people don't realize, is that bank-to-bank valuations on properties are quite different. So one bank may value a property at $1 million, and another bank might value it at $1.3 million. So, finding those niches actually gives you the opportunity to release the guarantee way quicker than normal.
Otherwise, saying, we see that those valuations can range from bank to bank. So that's where that annual review process is really critical under these setups, because if we can remove it in 2 years' time, perfect. Everyone's happy. Your clients are happy, and I think more importantly, the parents are happy.
I was just going to say, in most instances, that's just not the guarantors that are happy that it's released, because the kids also feel a sense of obligation. They just want to get that released at the soon as possible time.
And we touched on that, the family strain, you don't want to cause any issues there. But the way we set up the loans, the way we set up the offset account, our instructions for post-settlement, where to put the savings in the offset to reduce the interest, we give that to the client, because our goal is to remove that guarantee as soon as we can.
Yeah, absolutely. And I feel like a lot of people hear about guarantor loans and they know roughly what they mean, but not 100%. So there's some pretty common misconceptions. Just want to talk us through some of those.
So the parents having to put up the cash is the biggest one. So, that's not the case. We're just going to make it very clear that it's obviously their property. And what they're liable for. So as I said, it's all in the client's name. They're borrowing the money. The loans are in their name. It's not in the guarantor's name. As we said, and it's a limited guarantee. So in the simple scenario of the 20%, that $200,000 is what's secured to the guarantor property. They're probably the two most common ones. The other thing is they are very common. So we do a lot of them. The industry does a lot of them. The banks don't want to be taking away guarantor property, so they are a very good tool to use for clients looking to get into the market, whether it's owner-occupier investment, getting them into the market earlier, making sure they're comfortable. It's a great option to have.
So it is possible to do them for investment properties as well?
There's options out there. Not all will do it, but there are definitely options for customers to purchase an investment property whilst utilising this guarantor setup.
And then the other one that's funny with the misconceptions, and I think we said at the start of the podcast, it's kind of referred to as the bank of mum and dad, but that's usually when mum and dad are actually giving up cash, right? Whereas in this instance, we've repeated multiple times, they're not physically giving cash, they're just putting the property up as security, which is great.
It's a great option. It means they can hold on to their cash for other plans that they might have. That's right.
So we're just about out of time, but if you had one piece of advice regarding guarantor loans, what would it be?
So if you're thinking of buying, get in touch. You might be closer than you think you are to entering the market, because you don't have to save that 20%. If the guarantee is available from mum and dad, it's a really good option to enter the market.
Beautiful. Well, that's all we have time for. Thanks for joining me, Dill.
Thanks for taking me through it.
And thanks for everyone for watching.